Our next guest says many AI-related stocks were trading well into overvalued territory prior to Monday's sell-off, and anything that calls into question their valuation is going to cause them to sell off dramatically, which they did. Let's get more from David Sekera, Chief U.S. Market Strategist for Morningstar. Hi, David. Thanks for being with us.
Oh, of course. Good to see you.
Now, am I right in saying that, so you mentioned the valuations of these AI-related stocks, but you also say it doesn't really change your overall fundamental outlook on a lot of these stocks. Could you elaborate on that?
Exactly. So when I look at the market action yesterday, I think what we saw really illustrates our point in our 2025 market outlook, that 2025 is really going to be a year that we see the evolution of AI. So as much as 2023 and 2024 was all about the GPUs, the hardware, the networking equipment, and so forth, I think 2025 is going to be all about those companies that really can utilize AI to drive revenue and also be able to expand margins by enhancing their productivity. So specifically, we're really looking for those companies that we think they can improve their existing products or services, develop new products and services around AI, things that will really drive a competitive edge, which of course then allows them to capture new business, raise pricing, and defend against customer attrition. And of course then looking for those companies that can enhance their productivity. So if you look at some of the trading yesterday, stocks like Meta, Amazon, ServiceNow, those are going to be some of the better beneficiaries from AI, and we actually saw those stocks trade up yesterday and today. Whereas really as those hardware providers that got hit the hardest, those of course being the ones that you mentioned that we thought were overvalued, either rated 2 stars or some were even 1 star before that sell-off yesterday.
Now you've got the fair value on Nvidia of $130 US. It's trading below that right now. What is the overall risk here to Nvidia? We did float the concept earlier that maybe we've seen the peak in Nvidia. Its rapid growth may be subsiding here. What do you think?
Well, one thing you also have to realize, too, with Nvidia is that last year, we saw a lot of upside surprises in that stock. That was where the stock was still growing because demand was increasing at an increasing rate. We think that's changed. So while we are still looking for pretty strong growth in Nvidia, it's now increasing at a decreasing rate. And I think that's causing, some of the valuation adjustment that we saw when the stock just got overextended, earlier this year. But of course, the risks to the downside with, DeepSeek and seeing, what they've been able to put out there, it just could be that a lot of the Gen AI, the large language models specifically, might be able to be developed with fewer GPUs or even less expensive, less developed, GPUs than Nvidia have. And of course, then we could also see lower CapEx spending from the hyperscalers. So that would be more of their downside risk case. At this point where the stock is trading, really puts it within the range that we consider to be fairly valued, not necessarily trading, low enough to be something we think it's trading at enough of a margin of safety from its long-term intrinsic value. So I think it's a good 3-star solid stock at this point, but I see much better value elsewhere.
David, still with valuations, you say that the growth category is trading at about a 20% premium to fair value, and the last time we saw that was in 2021. So that's ominous. Are we expecting a repeat?
Maybe not necessarily repeat as much as I'm just looking for that rotation out of growth stocks and into value stocks. I think growth was down over 3% yesterday. Value was up 1 point something percent. So again, I'm really looking more for being market weight the market overall, but being underweight growth. As you mentioned, the last time it was that high was early 2021, and of course you remember back then that was the disruptive technology bubble. All those stocks that Cathie Wood and the ARK Fund had popped, and then we saw them tail off for several years thereafter. So really, I think it's just much more positioning yourself to be overweight in the value category, I think will pay off, and specifically high dividend paying stocks. So with the market valuation where it is today, don't necessarily see a lot of market appreciation in the first half of the year. I think we need to wait for earnings to catch up the valuations in the second half of the year. So I think high dividend paying stocks, which are oftentimes also value stocks, will be a much better place to put your money.
Some names you have in that category, Verizon and Kraft Heinz. So you think these are quite undervalued here?
We do, and they fit, that category of both being, very attractive value stocks, trading at very significant discounts, from their long-term intrinsic valuation, and also paying, very high dividend yields. Verizon, I think, is just under 7% right now. Kraft Heinz at about 5.5%. So some pretty good dividends that you can, essentially clip a coupon for a stock that we think, in Verizon's case, is trading at 25% discount to fair value, and Kraft Heinz at a very significant discount. That's a 5-star rated stock. That's our highest rating. It trades at a 50% discount from our long-term intrinsic valuation.
Now, sectors that you are also overweight, real estate, which is intriguing. You don't think higher interest rates are going to hit the real estate sector this year?
Now, there's two parts to real estate today. So first, real estate has long been the most hated asset class on Wall Street for at least the past, 18, if not 24 months. And I think part of that negative sentiment, really is what provides a lot of the opportunities in the real estate market today. As far as long-term interest rates, our U.S. economics team is looking for long-term rates to continue to come down over this year into next. So I think we're looking for a 4.25% yield on the 10-year this year, and below that, maybe into like 3.5% next year. But within real estate, I certainly like defensive plays. Personally, I'd still steer clear of the urban office space. I think there's probably more downside risk there than upside potential. But in the defensive plays, specifically companies like Healthpeak, which has medical office buildings and hospitals, we think that's very attractive. That's a 5-star rated stock, trades at a 33% discount, and pays about a 5.8% dividend yield.
All right. You also like energy, healthcare, and basic materials. Let's focus on some sectors that you're recommending underweight, such as consumer cyclical. The Home Depot's in that group. Why?
Exactly. Well, the consumer cyclical is trading at a 20% premium. Now, of course, the biggest reason for that premium is going to be Tesla. Tesla stock skyrocketed after the election, after President Trump won. I think that stock was up well over 60, if not 70% since then. It's now trading well into 1-star territory. That stock is almost double our long-term fair value. And of course, that is the second largest company within the consumer cyclical sector by market cap. So that does skew the overall premium higher. But even a company like Home Depot, while it has been doing very well here in the short term, has some very good short-term growth dynamics. That's a 1-star rated stock, trades at over a 40% premium from our long-term intrinsic valuation. That's one where we're looking for revenue growth and margins to normalize more over time. So we think the market's just over-extrapolating some of the short-term strength too far into the future.
All right. Thanks for the insight today, David. We'll talk to you soon.
All right. Well, thank you.
David Sekera, Chief U.S. Market Strategist